Hey everyone, this is Chris from Smithy Fitness and Finance, back for another video on the stock market. And I want to talk about how to trade Darvas style in 2021, because quite a few things have changed from 1958 when Darvas was pulling off his magic and where we are today. A lot has changed. So over the years with experience, I've altered or made small relevant changes to the Darvas system. Anyway, let's just review it a little bit from last time. Again, here we have a stock with the 4 phases of a stock's life. Now this is simplified. If you look at any chart, they're not going to be quite this pretty. But we have stage 1, which is the basing stage, stage 2, which is the upswing stage, stage 3, which is topping, and stage 4, which is the downward phase. We never want to own a stock in stage 4. We will only own a stock breaking into stage 2. And as we get into stage 3, we don't know whether it'll go up again or if it'll drop off. So we will own stage 3, but there's our sell point. So today I want to talk about stage 2 in particular. So I'm just going to erase this and we'll get into a little bit more depth of how to do the buying and selling of an actual stock. So this is all going to be phase 2 here. And we're going to show just the end of phase 1. It breaks out, consolidates, and away we go, and so forth. So here we are. Let's suppose that we've been watching this stock. It's been trading between, $18 and $20, and we're watching it, and this could be months. Or it could be just a few weeks, but it's going to be a bit of time. And again, like I said last time, we like this basing stage to be fairly long if possible. Now here's our buy point. And I'm going to spend about 20% of my money directed towards that stock on the buy point. So here it is at $20.10, let's call it. I'm going to buy 20% of my holding there. Now, if it acts proper, immediately I'm going to add another 20% pretty quickly. So call it here. I'm going to add 20%. So this might be $21, let's say. And this is $20.10. So here we go. I've got 40% of my holdings, and it's just started. Now, from here, I've got to watch it, because it may well just turn around and fail. And I'm going to sell it just down here. If it breaks through the low point of the basing phase, I'm just going to take a small loss and get out of it. But the fact that it's gone to 21, so I bought the 20%, it's carried forward, that's a really good sign. Now I'm going to watch it and see how the stock reacts. So here we go, it's gone up quite a bit. Well, on this it's showing 30, that might be an exaggeration of real life. But it's gone up quite a bit. I still own my 40%, but I'd like to own more of this one because it's working, and that's what I'm waiting for. So here it is. We've got $30 on the top. We'll call this 25 on the bottom. I'm not buying in here. It's too extended. It's gone too far past the breakout point. Once a stock is about 10%, 7.5% past the breakout point, I don't want to be adding, because I'm starting to get into spike territory and I don't want to own it. I don't want to add to it. So I'm going to wait. It hits its high, in this case of 30, then it comes back down and starts to go back up. So if I determine that this is the new bottom, I want to be adding in here. So I might add another 40% here. And then again, I'm going to watch it. It's doing the zig and the zag. Somewhere in here, I'm going to be buying that final 10%, that final 20%. It may be here. Maybe I'm going to wait for the next breakout. So at 30.10, I add the last 20%. Now I've got my whole position, and I'm in the stock, and it's acting right. It's broken out. I can put a stop loss here, or I could put a stop loss below the old range, or I could pick somewhere in the middle. There's a lot of art in buying and selling stocks. So to have hard, fast rules is really difficult. I'm often feeling, how is the big market? How is the Dow Jones or the S&P 500? How is that acting? And that can help me determine where to put a stop loss. But generally, I'm going to keep it fairly tight. We've got a winner here. My average price might be, say, $25. It's now trading at 31. That's pretty good. I don't want to lose all of that, so I'm going to put my stop loss maybe at 27.5, or maybe I'm going to have it even tighter in here. So that's how I'm getting my first position. Now, if the stock from here has a big move, let's see, it goes up like this, kind of crazy, it moves to 40. Well, I'm going to take advantage of that volatility and do a little bit of selling. I'm actually going to sell some and wait for that pullback and then add back into my position. So this is a little bit different from Darvas. And as I said, there are quite a few differences from 2021 to 1958, before I was born. And I want to talk about some of them. So the one is very low commissions. So back in Darvas's day, he was paying on average, let's call it 2% commissions, 2% to go in and 2% to go out. So it could be have been as low as 1%, but as high as 3% each way. So he didn't want to get shaken out, because the cost of just buying a stock at 20 and selling it at 20 was 4%. So that didn't work, and he wanted to make sure that he wasn't getting chewed up by commissions. So that's one difference. What we pay right now is almost nothing. I mean, I'm paying $5 a trade. My son, who doesn't trade as much as me, he's charged $10 a trade. I wouldn't go with the Robinhood, and those ones were at zero. I would rather pay something and know that I'm getting the best fill, but that's another topic. So that's one thing. So we don't have the big transactions cost, so we can easily go in and out of a stock. You know, I could get stopped out here at 1975, and then maybe it turns around and comes back up, and I can buy it back at 2050. It's cost me 75 cents as far as the stock movement, but it's cost me almost nothing for commissions. And then I'm back in after getting a false breakout, which is going to happen too, because as I said, stock trading can be quite messy. So that's one thing. We have high volatility. Back in his day, mid-50s or whatever, I think it was only something like 7% of the population played stocks, and it may well have been less. It might have been 4% or 5%. So the moves were not as radical. There was lots of time with low volume, didn't move very much, and he could just kind of relax and stay on it. Now, especially with what's happened with COVID, we've got so many players in the market. Almost everybody, or many, have a retirement plan, or a pension plan that the managers are buying and selling stocks. Indirectly, probably 70% of us are in stocks, or maybe it's a little bit lower, but it's a big number. And the crowd being the crowd, when it's excited, things go up big, and when they're depressed or worried, things go down big. So volatility is much bigger, and we do get these spikes. And I want to take advantage of that. I want to capture it, so I will sell. In fact, if we go back here, sorry guys, it's getting a little messy. Let me try to clean it up a bit. So here we go, I buy 10% here, and then I add 10% here. So this is 2010, this is $21. If this stock on the same day or within a couple of days runs up to 25 or 26, that's a pretty big move. I'm also going to give them a little bit. I'm going to sell a little bit. Maybe it's 50% of my 40%, or maybe it's a smaller number, but I would let a little bit go. So if I had 1,000 shares here, I might sell 200 here, 200 here, and if it keeps going, 200, 200, 200, and I'm out. And then I just wait, because there's almost always a retraction of some sort. So I want to be there and be able to capture that as well. So that's different from Darvas. Darvas would not worry about that. He would stay in it for the long term. That's that is definitely an option, but I have found that it's better to try to take some profit and play around your position a little bit, rather than go all in and wait for a 1 year with all this up and down along the way. We now have lightning fast execution, so you can buy and sell a stock on your computer and be filled in 1/10 of a second. I mean, it's unbelievable. Whereas, of course, he would have had to have called his broker. Now, this is actually very important. The stop buy point and the stop loss. So stop buying, a stop buy order is my favorite order, and I use it all the time. So again, let's take this example. The stock's trading 18 to 20, and I notice it here, back on November 28th. And here we are on February 18th. So we're way over here now. But I noticed that it's got this range. So I put in a stop buy order to buy 500 shares at $20.10 on stop. And then you put a limit on it. So I'll say 2010 with a limit of 2050, let's say. So that order's in the machine, and I don't have to watch it every second. I can be watching the other 50 stocks that I own. And I know that this is looked after. So when it breaks that 2010 area, boom, the computer says, okay, Chris wants to buy 500 shares at a maximum price of 2050. It triggers it, and I'm in. And that's a wonderful thing. It doesn't give you any chance to let your emotions get involved. Oh, it's been, in this range for so long. Do I really want to buy it? Is this just a false breakout? It really forces you to stay with it. So stop buy order is awesome. And on the other side of it, most of you will know about stop loss orders. I buy it here, and then I just put in an order. Okay, if it hits 1980, sell it with a, sell it at market, let's say. So just sell it at whatever price I can get. I do like to put limit prices on it, so we shouldn't sell it at market. So we'd have a stop loss 1980 with a limit of 1940, let's say. And it'll just sell it in between there somewhere, assuming the stop doesn't gap down. And we'll worry about that on another one. And technologically, what does the world look like in 58 versus 2021? So obviously we're all privy to all the information that you could want on your company. You can buy the stock and of course go into their website, read the press releases, see what analysts are saying about it, seeing what the bull boards are saying about it. Bull Board Stockhouse in Canada. Again, that's a topic for another day, but you can do a lot of your own research on it and see what the balance sheet looks like, the last earnings results. Do they have a new product coming out? How did they do this quarter versus a year ago, that quarter? So all this information is available. And truly, although we're talking about technical motions in a stock right now, we want the fundamentals to line up as well. And so after the stock is showing it's in a stage 2 and I'm buying it and adding to it, I do like to go into the website and see how the company's doing. So technologically, we're so much more advanced than poor old Darvas, who was sending telexes around the world to let him know what the price of his stocks were. And he still, operated tremendously. So this is kind of what we're looking at. Stage 2, staying with it, adding as it goes. Now, stage 2, it can last 1.5 years. It can last a very long time, and that's where your 3, 4, and 5 baggers reside, is if you can stay through all the ups and downs. And I've had quite a few, but they do test you. They will have their big down times, and you can get stopped out, but maybe you like the story, so you're looking for somewhere to come back in. So that is definitely a topic for another day. Okay, right now we just want to talk about where we're going to get in and where we're getting out, and the ability to take some profits along the way if the stock goes big time. Now, the other day I mentioned that don't pay attention to tips, to newsletters, brokerage reports, people on Twitter who are financial people who are giving tips, buys and sells. That's definitely what Darvas believed in. My experience is that it's worth listening to tips, but then go and check the chart of the stock. So look, if you get a tip, it could be, a mining stock, and let's say that they just drilled a really rich hole of with gold in it, with high grade, and the stock has sort of done this, is doing this, and somebody on Twitter says, "Oh, look at this! They've got 8 grams per ton, which is a good grade for gold." And they've got all these tons, and once they pull it out of the ground, this company's going to make so much money. And the stock has already taken off, and it keeps going, and you're watching it, and I should have bought it. But this is so dangerous. Do not buy the spike, because even though you might not buy at the top, you might be buying here, and then it's going to have its natural reaction. And then over time, it'll go again. But this is where you want to buy it, or maybe down here if you can determine that that's the low end of the range. Do not buy the spike, and that will save you a lot of grief. But there is this fear of missing out that you'll emotionally feel, and you have to just let that go. So listening to tips are fine, but go and look at the chart. If the chart is basically, it's in stage 2, but it's in a consolidation phase, and the guy, whoever it is talking about it, and the stock price is here, put a stop buy there if you think the story is good. Don't buy it here. It's got to prove itself. It's got to prove itself by breaking into a new range or a new higher box, as Darvas would say. So there's some really good guys that I follow on Twitter, and I've gotten some very good tips from them. But it's always on me. If I'm going to buy the stock, I've got to do my own due diligence. I can't be direct messaging them or whining, hey, it's going down or something. This is my pick, your tip. I appreciate you sharing the tip with me, but I've got to do my own work. And listen, if the technical vision of the stock isn't in a buy position, you can't buy it, particularly if it's a stage 4 situation, like some of the, GameStop again is in the news today, but it could have been any of them, Cineplex in Canada, where they're on they're coming down, and somebody's saying, well, it's great value and it's gonna start to go. Never buy a stock that's falling. Very dangerous. It's an advanced play. I do it from time to time, but it's a really advanced play, and it's a great way to get burned. So I would avoid the stage 4. We always want to be in the stage 2 stocks after they've finished their consolidation. So I think that's it. Please put any questions you have in the comments below. I'll try to get to it. I have so much knowledge of the market that maybe this is a little bit scattered, but dig through it. There's a lot of great info in here. It's served me well through 37 years of trading. I've had some great years, including now. So good luck to you. Trade well, and I'll put out a new video in the next week or so. Oh, and my fitness side of it, listen, I've been a little bit injured, but I'm still training, and I'll have a fitness video coming out in a few days. Remember, it's health and wealth. We want them both, and let's live a prosperous and healthy life. All right, guys, please subscribe, and if you found this helpful, hit the like button, and I'll talk to you in the next one.